Hey Steve, how you doing?
Yeah, good Sam yourself.
Yeah, awesome, man. Been a few weeks since last time we met up,
Yeah, it's been a
but
little while.
yeah, it has been. Really excited for this one. Just to kick us off, I wanted to first discuss some of your recent trades you've done. You announced last week the sale of one of your holdings, where you turned $200,000 investment into $2 million. Can you tell us a bit about that?
Yeah, sure. So I've shared in other videos how I've been bullish commodities, in particular energy commodities like coal. And I'm still very bullish coal moving forward. And so I've got several coal stocks, a couple of Australian coal stocks that I bought at 1.8 times earnings, and I haven't sold those ones. But I bought Peabody Energy on the New York Stock Exchange. I think I first bought it on the 12th of October for $1.65 from memory. And then I bought some more in November at about $1.23. And yeah, it was about $200,000 worth. And I just sold them last week for $16.52. And so, yeah, and in the meantime, over that 11-month period, I also sold out of the money covered calls and made might have been about $250,000 in cash flow during that time period. So it's been really good. And look, usually what I do, look, the reason why I sold it is, well, the timing of it was due to tax reasons, but the reason why I sold it is because I've found some other stocks that I want to put that capital into. I think Peabody had a fantastic run up. Now I intend on selling the rest of my Peabody, so I haven't sold them all. I just sold the first batch last week, and I will sell the rest. Usually what I do is I have a trailing stop loss that sells me out. And I've learned a few lessons over the years by having trailing stop losses too close to the actual share price, and the stock may have a quick little correction and then run back up. In the meantime, I've been sold out. That happened in a company called Certex Medical. I bought years ago. I can't even remember what year, for around $1.70 odd, and it was in the $7 to $8 region, and it corrected. So I used to have a trailing stop loss at about 10% under the actual price, and there was a little correction. I was sold out. Well, that stock continued up to about $42. So at the time I thought, oh yeah, take my profits. Yeah, cool. Look how good I am. Yeah. When it went to $42, and I realized that kind of hurt. And it also happened to me a second time. I bought a stock called Altium around the same price, around $1.70, $1.80, something like that. And also between that $7 and $8 mark, it corrected and I was stopped out. And look, I don't know what that stock is today. I'm pretty sure at one stage I saw it hit about $32. You guys can go fact check me on that one. But yeah, I stopped looking at those stocks when it hurts so much, when I leave those profits on the table. My business partner likes to tell me, it's not like you made a loss, you made a very good gain. But anyway, so now I have my trailing stop loss between 15 to 20% below price. So usually I let the market, when it's actually in a full bear market, when it's crashing, it'll stop me out, and I'll take those profits. However, I decided to sell on this occasion. Now Peabody may run up a bit more. I don't know, but it's had a fantastic run. But the reason why I sold it is because I've identified other stocks. So two oil producers and an oil refiner. Their cash flow yields 11.2%, 12.3%, and about 16.7% from memory. one of the oil producers has a PE of 3 times earnings, return on equity 12%, no debt, and 40% of its balance sheet is cash. So or 40% of its market cap is cash. So I'm bullish oil. I said in one of our videos that we did together, you asked me a question. This is going back a few months now. What I thought. 2 predictions towards the end of the year. I can't remember one, but I said the other one is oil at $90. Well, oil's in the 80s at the moment, so that trade's looking pretty good. And that's when oil was falling back down in the 60 range. So, I'm still very bullish on that. Now, 2 of those stocks are Australian. One's actually a Russian company, and I'm actually looking a lot closer at some Russian investments at the moment as well. So that's the reason why I did that. The other coal stocks that I've got, I won't name them. I only name stocks once I've sold them because I don't want to be looking like I'm pumping certain stocks or giving financial advice. I don't do that. I'm just a trader, and I try to educate people and get people to do their own research and whatnot. But I do still hold some other coal stocks, which are up probably 200, 300, 400%. But those stocks, so Peabody hasn't paid a dividend in the last year, even though I've sold cover calls for income on it. These other stocks that I've got do pay dividends, and the dividends are based on my buy price, and I bought them very, very cheap. As I said, some at 1.8 times earnings, others 3-4 times earnings. They're paying me an 18% fully franked dividend yield. Now they've risen up a lot, so that dividend is back in single digits, mid, maybe high single digits. But that's an 18% fully franked dividend. What does fully franked mean? Well, it just means based on my structure, I don't pay any tax on those dividends. In fact, I'm likely to get a tax credit. I'm likely to get a check in the mail for even more cash on that. So, and as I said, I'm bullish coal moving forward, even though it's had a fantastic run and it's probably overcooked. Maybe not quite yet because of the problem that's happening in Europe, the energy problem happening in Europe. And I expect the energy problem to get worse as we continue to move towards this ESG net zero, absolute garbage. I really have to put a filter over my mouth on this one. Chris McIntosh, who, for those of you who don't know, he's the guy who's on the picture of this thumbnail on this video. He's got a blog, and I recommend everyone sign up to it. It's a free blog, Capital Exploits. Just Google Capital Exploits and just get on there and sign up for his free blog, free newsletter. You can't share any of his research and blogs and all that on social media because he's been banned, because he spells the truth on the whole energy sector and how to invest in it and whatnot. And to be honest, a lot of these gains that I've had in coal are partially due to him. So, so it's been fantastic. So I'm not selling those other coal positions, even though I could see the price of coal, coming down quite a little bit. Nothing goes up in a straight line, but I still see an energy crisis in the decade ahead, and potentially. And I'm going to do another video later this week, on what the heck is happening in this space and how the global elites are going to cause food shortages, mass starvation, and complete civil unrest. And I'm dead serious about this. I'm dead serious about what's happening. And it's really economics 101. And you don't need to have a doctorate to understand that all this stuff isn't adding up, and it's gonna, it's not going to end well. So anyway, so that's that trade.
Yeah. And I heard that you you had like another trade that currently went up over 700%. I think in recent times you shorted a stock, made that kind of profit. Can you tell us briefly about that as well?
Yeah, so I think in videos, I may have even named the stock in some other videos. I don't usually do this, but so when I was looking at what was happening with Evergrande in China and looking at the credit situation, the credit markets in China, I saw, or I believe there was going to be a slowdown. So when you look at, that property development makes up 25-30% of China's GDP. So there's different numbers. Some say 25, some say 30%. Take it with a grain of salt. And they're the largest purchaser of iron ore. Iron ore is our largest export by quite a while, quite a way. Coal second. Between coal and iron ore, that's almost 50% of our exports right there. So I saw a slowdown in China. I saw that they won't be buying as much iron ore. And iron ore at the time was over $200 a ton. So I got bearish on that. I just waited a little bit. I didn't rush in too early. Iron ore started falling off a cliff at that point. And it was Fortescue Metals, which I've traded over the last decade. It's been a great stock for me, trading options on both buying options and owning the stock, selling covered calls, selling naked puts. I love the stock as a trading stock. And look, it had run up dramatically. I actually owned the stock 2 or 3 years ago. I can't even remember now. Time's flown by. I bought in at 350, 360, sold covered calls over about nearly an 18-month period up to nearly $8, and was getting about 2.753% a month in premiums. And then it had a big spike, big run up in 1 month, and I was exercised and I never bought back into the stock. So I doubled my capital, doubled my profit there, and made nearly 3% a month for 18 months in cover call premium. So that was very good. But it continued to run up into the high 20s, and I was like, wow, this thing is, and that's its all-time high. And so when the iron ore price started falling, and seeing what's happening in China, I expected the iron ore price to continue dramatically. And to be honest, you look at two charts, you look at Fortescue Metals and iron ore, and they trade very nicely. There's good correlation. So usually I'll trade bear call spreads and whatever in down markets. So I've got kind of insurance or cover, protection. However, I just went, I feel I'm right on this trade, and I just bought put options, straight out put options on Fortescue Metals. And so Fortescue has come down from the high 20s to about $14. Might have just bounced back up late last week. I haven't looked, but the option premium is up about 700%, or just over 700% now. So I still have those. The expiry on those is the December expiry. So I've got a little bit of time left, but I don't like to hold options to close to expiry. So I'll be getting ready soon to pull the trigger and sell those options and roll out and take those profits. So that's looking quite good for me at the moment as well. I'm still bearish iron ore. I think iron ore is going to $70. I think Fortescue Metals is going below 10. For me, it's just timing. My options expire in December, so that needs to kind of get a wriggle on if I'm going to make more profit on this trade. However, that might happen, first quarter next year or something, and I'll already be out of the trade. So that's that trade.
Yeah, awesome. Yeah, you mentioned before about Evergrande in China. How is that situation going to impact the global economy and financial markets if like at all?
Yeah, good question. Depends who you speak to. Depends on how that's going to affect the global economy and financial markets. So some are saying, that obviously people are comparing them to Lehman Brothers because of their debt size. They're got about 5 or 6 times the amount of debt that Lehman had when they went under. And so some are out there calling that there's going to be a financial crisis, and asset prices are going to crash 80 or 90%. And then others like, no, it's going to be contained. Beijing, the PBOC will, that's the People's Bank of China, will bail them out. They'll contain it, whatever. My opinion is somewhere in the middle of that. I don't think the PBOC are going to bail them out. If they were, they would have done so already. We've already seen Evergrande miss bond payments. So what that has done is there's other property developers who are now in trouble. But even the good property developers in China who are very profitable, who have good balance sheets, they're now starting to get a bit some issues because they're struggling to get finance, struggling to get funding, because especially international investors, but also within China, they're not wanting to lend to a property developer because they're wondering, are you the next Evergrande? If I lend you my capital, am I saying goodbye to it? And so, and look, there's a couple of theories around what's happening in China. Are China really a capitalist country? Are they embracing capitalism unlike us, which means they allow for creative destruction, for over-leverage companies that speculated, misallocated scarce resources and have malinvestments to go bust to cleanse the economy? Some argue that. I mean, compared to what we do in the West, which is just create zombie companies by just bailing everyone out and the big end of town. So, create moral hazard so they continue to speculate and just, it really frustrates me. So I'm not going to go on that rant. Others say that, no. Beijing are now, they've allowed this kind of capitalist kind of economy to really build up China, and now they're transitioning into full communism. Apparently, when Russia collapsed, when Soviet Russia collapsed, China sent some of their economists into Russia to study why they collapsed, and apparently they came back and said, well, Russia, their problem was they went straight from feudalism to communism. They didn't allow for capitalism to build up the economy, and that's why they collapsed. And so China's strategy was to allow capitalism to build things up, but now they're transitioning to the full communist model, and perhaps that's what's happening with them, taking over some large companies. There's talk that they are taking all the good assets out of Evergrande and other property developers. So we could be seeing a full move to communism there. How that's going to impact? Look, Xi Jinping has been clear about he wants to end this speculative debt bubble in China. So how do I think that's going to affect the global economy? Well, China have been really the engine driver for the global economy, at least the last decade, probably the last 2 decades. We've got really a sick, weak global economy. Our fundamentals are sick and very weak, and central banks and governments are just trying to keep it up, and it's really, really sick. And this is where I'm in that whole stagflation thing, because I think the underlying economy is bad, But due to government policies and central bank policies, we're going to have inflation. So we're going to have this stagflationary environment. Some then say hyperinflation. I can't even get my head around that. So let's not go there. But with them not buying the iron ore, if they do allow the debt bubble to collapse in China, then you're going to have some banks that are going to be in trouble. Like I'm talking HSBC, maybe Deutsche Bank. Then what's the flow on from that? I think Australia is going to impact Australia more than most countries because we rely on them so much for our trade, and so that's going to impact both the federal budget, state budgets, but I also think it's going to affect and have an impact potentially on our property market. So ultimately, we don't know exactly how this is all going to play out. But I said in my first video that I did on Evergrande, I think I've done 2 videos on it. The first one, I said, just keep a close eye on this. Watch it like a hawk. And that's what I'm doing. And I'm looking at information on both sides. No, she's all sweet. No, this is going to be Armageddon. I'm looking at it all and I'm just soaking it in so I can try to be nimble with my portfolio and work out, how that's going to impact, financial markets. So I think it's definitely not bullish for financial markets. So, if you're just wanting to get in, especially on index funds or ETFs and that, no, I better not say. That might be classified financial advice. Just be careful. That's all.
Yeah. Very interesting. That whole Evergrande. Yeah, it's very interesting. So I'm just going to finish off with a couple comments because we're running a bit out of time. So there's a couple comments in your last few videos, and I picked from. This is from Ibisman. He commented this 4 days ago. He said, when you mentioned debt to GDP, do you know what Australia's debt to GDP rate is, please? I heard the name statistics somewhere recently myself, and being an Australian like yourself, how does Australia's overall economic position compare to that of the US?
Yes, I've done a couple of videos about the Australian economy. I think I did them in a couple of, part 1, part 2, and also Australia's property market. That was going back several months now, so people can go have a look at that. But I did reply to Ibisman, and I did say that Australia's total government debt, including state, is $1.4 trillion. Federal debt is a bit over 900 billion and growing very fast. Now, our GDP is about 1.35 trillion. So our total debt to GDP is now over 100%, or close to 70%, if you just take the federal debt to GDP. However, and that's bad, and it's growing fast, very fast, one of the fastest in the world, actually. However, our household debt is now over $3 trillion, and total private debt is over $5 trillion. So when we measure household debt to GDP or household debt to income, Australia takes the gold and silver medal on those 2 accounts. So put it this way, if interest rates rise a little bit, we could be in some strife. In fact, let me just quickly share my screen because I think this is very important. Share. All right. So let me know when you can see that.
Yeah, I can see that.
Yeah. All right. So this is the US 10-year bond, which is classified as the risk-free rate, where all kind of financial assets are valued upon, and we are seeing a rise in that. But let's touch over on. So I keep an eye on this all the time. The Australian 10-year rising, very similar to. So not quite yet back to the February March highs that it got, where it went over 1.8, but it's moving up. But what's really interesting is the 3-year. So let me just go to the 1-year chart. Actually, we'll go back to the 5-year. So when the Sebaceous sickness started happening and the RBA were starting to cut rates. All right. So the last time our 3-year is at 0.633. Okay. The last time it was at this level was in February before they cut rates. The RBA cash rate at the time was 0.75%. It's now 0.1. So, the bond markets are telling us that higher interest rates are around the corner. The New Zealand Reserve Bank raised rates the other week, and now their cash rate's now at 0.5%. We saw the Polish central bank raise rates. We've seen the Russian central bank raise rates. A number of central banks are now starting to raise rates. If interest rates rise, then, and you can see this chart, like it's come off 0.1% to 0.61, 0.67, sorry. So, if interest rates rise, even back to 0.75, we've seen a lot of people rush out and buy homes recently. Our business, our mortgage broking business, in the last 12 months, we've never written the volume of loans that we've ever done in our history, and we've been around 18 years in the mortgage broking industry. So there's going to be a lot of pain, because at the moment, 41.3% of households are in mortgage stress, which is a cash flow measurement. So, interest rates won't have to rise all that much for there to be issues. So I'll stop share. So, I think, when we look at our economy, you look at the OEC for complexity, our economy is ranked 79th in the world, meaning, we don't have a diversified economy. We dig stuff out of the ground, ship it overseas, and then we have this jet-fueled property bubble. That's our economy, the wealth effect. That's not sustainable. That's kind of like a Ponzi scheme where, you just build debt upon debt upon debt to consume. Consumerism. Consume. The word consume literally means to destroy. Think about that. So, and if China does slow down, if we have a recession, China-led recession, our iron ore, is going to impact our economy. If interest rates rise due to inflation, that could pop some financial assets, including the Australian real estate market. How much could Australian real estate fall? That's not my forte. I don't do that. I just think that it could be in a bit of strife. Anyway.
Yeah. Really uncertain times we live in now. Just go the last comment. This is from Juice Brown. 3 words he commented in the last 2 videos. He said, "Let's go, Brandon."
Yeah, I saw that. I commented on it. Yeah. I think I said comment of the day or comment of the video or something. So what was his name again?
Juice Brown.
Juice Brown. Let's go, Brandon.
Oh, great. Awesome. Well, yeah, thanks so much for this talk. Really enjoyed it. Yeah.
No worries, Sam.
And I'll see you next time.
All right. See you, buddy.